Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 on my 5-part series on the company Ryan Air. This time we're going to talk about the company's operations. When you start looking at a company's operations, the first place that I always look for the company is gross margins. I look at gross margins as a really good determinant of whether the company has some sort of consumer monopoly, whether they're able to raise prices in good times and bad, whether they're able to survive recessions, things like that. What you're going to find with Ryan Air, like most airlines, is that it doesn't really have a traditional monopoly. It has relatively low margins. In fact, the margins, as you can see here, the red line here represents the minimum gross margins I would consider investing. And you can see that Ryan Air kind of bounces right around my minimum number. But they are at the minimum number, so it's worth continuing to consider it. When I'm looking at commodity businesses, and airlines are probably the best example of this, I like to find companies that are the low-cost provider. My thinking is that if they are the low-cost provider in their marketplace, then when the going gets tough, they start losing competitors because their other competitors are even higher cost providers and they are losing money before Ryan Air is losing money. And you can't lose money indefinitely. Most airlines are not well capitalized to lose money for even a midterm, let alone long term. And so when something happens like what's happening with COVID that's really hard on the airlines, it tends to thin the herd out and it makes a company like Ryan Air come out the back end stronger. So that's the real reason why I'm buying Ryan Air. Their margins are okay, but I think they're the low-cost provider, especially in European travel, and therefore, they're like the Southwest Airlines really of America, and that's why I'm excited about the company and why I think the company's going to do well, in the mid to long term. I'm not sure that this is a 10-year hold, for example. I think this is just opportunistic investing, a good, solid company that's been beaten up by an economy that's not going to continue to be as bad as it was. The economy's going to recover, the company's going to recover, and then we're going to do okay. This slide, of course, we care about companies' ability to make money, and this slide looks at the company's earnings per share. Now, you can look at the last couple of years if you want to, with what happened with COVID, et cetera, et cetera. I would prefer to look at what's happened from 2001 till 2018 or 2019. This company has managed to grow its earnings every year. Obviously, it dropped in 2009 when the recession struck, but then it bounced right back. And so you see a company that in the aggregate, in the long term, has been able to do pretty well. It's got good management. Obviously, when things go bad, this company takes a big hit, but then it bounces back. And that's what I'm going to expect is happening here. Yes, this company took a big hit in the last year because of COVID, but I believe it's going to bounce back stronger than ever, which is why I'm suggesting we should buy this stock. This company does a pretty good job for companies with relatively low gross margins of converting net earnings to revenue. And you can see here that they're actually in the top 25% pretty consistently, and some years they're even in the top, they're approaching the top 10% of companies in doing that. Another thing that's interesting, if you look at the revenues, they just plummeted in 2019. Again, that's because of COVID, but the earnings didn't plummet nearly as precipitously. That's a really good sign that the company, what that tells you is that the company was able to shrink the amount of supply that they had. So they weren't flying with a bunch of empty seats. They just didn't fly as many planes. And so they weren't creating as much revenue, but their costs were able to reduce dramatically as well. And so they actually kind of survived okay during COVID. Again, this company is not super healthy today because of COVID, but I think it's going to come back and it's going to do fine. I want to take a second and recap sort of the way I think about operations for a company and the way I think about what's happening with the company. The top line is revenue. That's how much money they make selling their particular goods and services. That is what it is. The next line is cost of goods sold, and that's what it costs to produce that good. I like companies with relatively low cost of goods sold, which gives me high gross margins, which means that my company's got lots of positive attributes. Once we get below that gross margins, then we start looking at the things that it takes to run your business that are not directly related to the production of the product. And so there's selling and general administrative, there's plants and equipment, there's research and development, there's interest payments, and there's inventory. Those are the kind of what I call the 5 taxes. Those are things that every company has to have to some degree as part of their operations. And the question is, how good a job do they do with those things, or how significant a cost of those things for that business? So you can imagine a pharmaceutical business, for example, has a tremendous amount of R&D. A company like Apple has a tremendous amount of R&D. There are also companies that have tremendous inventory. And the problem with inventory is you've got money tied up in products that haven't yet been turned into profit. And when you look at inventory, if I'm gonna have inventory, I want it to be a company like Oil-Dri Corporation, where the inventory never goes bad, versus having inventory in a computer company where 2 years from now, every computer in your warehouse is worthless because the technology moves so quick. So when we look here at this company and these costs for selling general administrative and plants and equipment, which are two of the taxes, selling general administrative for this company are actually pretty low. They're in the top 25% of companies. That's great. Plants and equipment, as you would imagine for an airline, are very, very high. It's a very capital intensive business. You have to have airplanes, you have to have hangars, and you have to have all the equipment that it takes to move the luggage and everything else that goes on with an airline. And so you're going to find that the weakness for an airline company, amongst other things, is this tremendous plants and equipment cost. And so we know that's high going in. You just have to expect that every company has some area where they're weak. And with an airline, it's Ryan Air, it's plants and equipment. Making up for the really high plants and equipment in an airline is inventory. The inventory of this company is effectively zero. Now, you might argue that that's not accurate. You might argue that their inventory is every seat on every plane that they own, and that would be fair, but that's not the way inventory is really looked at as an accounting process. Also, they have the ability to mothball their planes and dramatically reduce the cost of operating those planes. And so that's why inventory is a little fuzzy with an airline. But in terms of pure accounting terms, the airline's inventory is zero. The same thing with R&D. The airlines really have no R&D costs. So while their selling and general administrative is pretty good and their plants and equipment is really high, the inventory numbers and the R&D numbers are really pretty strong. And that's the kind of thing that allows an airline to continue to survive, because it doesn't have some of these costs that other companies have. The next thing that I look at is interest payments. And when I'm looking at interest payments from the standpoint of operations, I want to see what are the interest payments as a percentage of operating income. And I have a goal, and if the company's below that red line, then we're in really good shape. And I don't really worry too much about the interest payments unless they're kind of inching up. And you can see here for Ryan Air, the interest payments are pretty steady. They don't really seem to be a problem. And so I'm pretty excited that, that interest, believe it or not, isn't a gigantic problem for Ryan Air. And by the way, it's generally a major problem for airlines. Airlines are forever going bankrupt. And I think Ryan Air is not really in a position where that's likely to happen in the foreseeable future. So in summary, I look for companies with a gross margin of at least 40%. The minimum gross margins that I'll look at is 20%. This is an airline. Its gross margins are very close to just slightly over 20%. For most other businesses, I wouldn't look at buying a company with margins this low, but I know that this is the way airlines work, and I happen to think that this airline is going to have a recovery from COVID, which is going to boost its stock price. Earnings in general have been upwards over the last 20 years. There's been noticeable exceptions due to recession, obviously due to COVID. It's also been very noticeable that this company's profits tend to rebound pretty quickly when things recover, which is what I'm counting on and why I'm buying the stock. The company's hovered around the top 25% of companies in terms of income as a percentage of revenue over the last 10 years. The company's selling and general administrative is pretty average, but it has been gradually improving, again, until COVID. Plants and equipment as a percentage of assets are predictably high because it's an airline. However, R&D inventory are both zero, and interest payments are in the acceptable range. So generally speaking, in terms of operations, this is a very, very well-run airline. The airline business, I believe, has been through a really hard time due to COVID. I think that's without question. And I believe this stock will bounce back significantly when COVID is over, which is the reason I'm suggesting you buy it. Again, I think this is an undervalued company, more of a Graham investment than a Buffett Munger investment. I'm not sure I'd say this is a long-term forever hold. The company doesn't pay a dividend, which is one of the reasons why I wouldn't hold it forever, but I'm happy to hold it when I think it's undervalued, which I think it is right now.